any investor should have the S&P 500 as a cornerstone of their investments. Now, not even necessarily owning it. However, if you aren't paying attention to the S&P 500 and where it's at, you're probably not doing a whole lot, right? The S&P 500 is a pretty standard metric for where stocks are going. Obviously, there's the Russell 2000 as well. That takes some of those smaller stocks, right? However, the top 500 companies in the United States is going to dictate where most of the world is economically, right? If we're in a recession, the United States is in a recession. Probably a large chunk of the Western world's not doing too hot as well. But just broadly, the S&P 500 is probably one of the most important things to pay attention to as an investor. Also, owning it is important, certainly in retirement accounts, that sort of thing, right? I would assume most people have a large portion of their retirement in the S&P 500, and that is a pretty good thing to look at. VOO, of course, is an ETF that mimics the S&P 500. It's the Vanguard S&P 500 ETF, right? I'm not saying anything crazy here. Hopefully, I'm not dropping any bombs on your head. Most of you can read. However, it is important to take a look at it, right? And it's important to always be mindful of it. Whenever I do stock comparisons on this channel, I'm assuming there's people new here, but I always compare that said stock to the S&P 500 because that's going to be a good metric of where it's at. Is it overperforming? Is it underperforming? Is it cheap, right? If it's 10 PE, right, and it's gone up 80%. Well, yeah, it's underperforming the S&P 500, but at this current ratio, 30, 27, somewhere in that range, right? You're also getting it incredibly cheap compared to the S&P 500. So you got to factor that in, right? It could be twice as expensive as the S&P 500, but it could be up 800% over the last 10 years, something like that, right? So it's always important to reference the S&P 500. In case it wasn't clear early in this video, the S&P 500 is just the top 500 companies in the United States, give or take a couple, depending on some moving in and out, right, at any given time. And it is dominated by tech. IT makes up 31.7%, right? We can scroll down and see some of these companies specifically, right? Just Apple and Nvidia make up about 14%. Throw Microsoft, Amazon, Google, all that on. A lot of the top, that maybe 20 to 25%, is almost just Mag 7, just because those companies are so large, so huge. And yeah, so maybe and honestly, part of the reason it's continued to go up so much, a lot of that growth is driven by those top performers, by certainly Nvidia, Apple, Microsoft, those ones are actually driving it up. Now there's other stocks and they make up the rest of the almost 66%, other 2/3 of it, right? You got financials, healthcare, all these sorts of things, right? And so there's still diversification in it. However, it doesn't really matter too much. You don't have to diversify the S&P 500 because if certain industries start doing well, you're going to own them and they're going to do well. That's one of the main advantages of an ETF like this that is broad, is if an industry starts winning, you're going to do well, right? You have that Nvidia and you're going to catch some of that growth. Now, you aren't necessarily going to have all of it, right? Because if you had 5% of your entire portfolio in Nvidia, like 2 years ago, clearly you would have outperformed if you had whatever small percentage the S&P 500 did. But you're always going to get the winners, right? And eventually the losers will get kicked out and replaced. So S&P 500 it's standardly safe. Now, as a long-term investment, it's absolutely going to do well. Some people don't realize, if you zoom out, there are substantial times. Apparently it's going to freeze on me, so we're going to ignore it. But you'll have to take my word for it. But I know what I'm talking about here. There is time periods where it will go down and run sideways. It just happens, right? Recessions, right? Or like the dot-com bubble in 2001. If you bought at the peak, you would be down for 5 or 6 years, right? Till about 2006. If you bought at the peak in 2007, you'd be down or sideways till 2012, right? So it isn't just free money. It can go down, but over a long period of time, 10, 15, 20, 25, 30 years, you're absolutely going to perform well. It's just will. And honestly, if it doesn't over 30 years, the economy's probably trash anyways, right? Like just generally, you probably aren't going to be doing well in most areas. If the economy really truly is that stagnant, companies are that stagnant, GDP growth isn't happening, things are not going well, right? So as a long-term investment, retirement, there's a reason retirement accounts are set up in these sort of ETFs, right? It's so important for that too. Right, and like I said, I think I referenced this, but maybe not historical return high, historical risk average, right? You can obviously go safer or more risky, probably get higher return, probably get lower. But then again, you may, with the higher risk, if you go higher on it, like a bunch of risky stocks, and certainly if you aren't diversified well enough, you could also lose quite a bit on those as well. So it's all a balance of risk. I did a video on risk if you're interested in that, but there's nothing super crazy I want to talk about VOO, right? Or the S&P 500 in general. It is important. It's important to reference to as an investor, even if you never owned it, which you probably should. I don't give investment advice on this channel. However, I think most standard investment advice would say S&P 500 is decent to own, certainly long term, right? That sort of stuff. So I'm not saying anything crazy here. I'm really not. But the S&P 500 VOO is important. If in your retirement accounts, you probably should look to own it or own similar stock. You basically can't balance risk with reward much higher in the long term than this. VOO is very important for everyone and everyone to pay attention to. Honestly, you could probably get away with 3 indexes ever just to look at to see how the broad market is doing. Russell 2000, the Nasdaq, and the S&P 500 would tell you broadly how everyone is doing. But anyways, that's all I got for this video, guys. If you enjoyed, I'd appreciate it if you left a like, subscribe. If you are new, whenever someone subscribes, it really helps YouTube recommend my videos out. They realize, hey, people like this guy, and then they recommend my stuff out. So it means a lot to me when you guys do that. But anyways, I appreciate all of you for watching. I'll catch you next time.